just kind of getting an intro to Chapter 6 and what we're going to be talking about. We talked about these, some of the information that we need in order to make the journal entries that are required, those payroll journal entries, and where we find that information. So we're going to need to look at the payroll register as well as the employee earnings records. And I had mentioned before, I'm not going to go through those in detail again. You've been working with those in depth throughout the entire semester. I'm sure you're familiar with the information that is contained within each of those reports. So there's really no need for us to rehash all of that. But just to know, we do need the information from those reports in order to create those journal entries. We are going to enter all of that information into the general journal in our accounting records. So we need to, there's several journal entries that we're going to make. Two of them are made at the time that we actually pay an employee. So when we've got cash going out, that's kind of the trigger to know, okay, I've got to make this journal entry. And I see a few of you just joined in. I'm sorry if you didn't. I didn't know until, well, whenever, like I sent that email out minutes after I realized my kids were not going to be going to school. So as of last night, I thought they were still good to go, but they both woke up with fevers. So so if you're just joining me, I assume that means you just found out that we're meeting online. So thank you for being flexible with all of that. Let's go back to we'll go back to the journal entry. So there are two journal entries that we need to make at the time that we actually pay employees. So the trigger for that, those journal entries, is there's cash that's going to go out. There's cash that's going to be paid to employees. There's another journal entry. It could be a series of journal entries, or you can make it into one big journal entry that is made then when we pay the liabilities that we have accrued as a result of paying employees. And by that I mean, so when we pay employees, remember, we withhold taxes from their paycheck. We may withhold other types of garnishments, whether they're involuntary or voluntary types of garnishments. We withhold things like insurance payments. So if they have health insurance or life insurance premiums that are being taken out of their paycheck, we withhold all of those amounts, as well as taxes that are owed to the state. And these are all things that the employee pays, not the employer. But when we've withheld those amounts, then eventually we've got to pay those then to whoever the recipient is. So in the case of income taxes, Social Security, Medicare taxes that have been withheld from an employee paycheck, we withhold that. We make the journal entry at the time that we pay the employee. We withhold those funds, but then at the time that we actually make the payment, send those funds to the IRS, we have to make another journal entry. So again, we've got cash going out at that point. So both of in both of these categories of journal entries, our trigger is essentially we've got cash going out. We're either paying employees or we're paying government agencies or insurance companies, some other entity that is owed the money that has been withheld from employee paychecks, as well as funds that the employer owes, right? So, but again, we've got cash going out. So that's the trigger for that kind of second grouping of journal entries. They happen at different times though. So because we've got cash going out at two different times. And then we've got a separate category of journal entries that happens. We don't have a cash trigger that occurs when we make these journal entries. It's the end of the period. And these are journal entries where we have to accrue certain expenses that we have incurred, but we have not paid yet. So we kind of have three different times that we're making these journal entries. And so that's those are the journal entries that are listed here that are entered into the general journal. So first one, we journalize the gross payroll and the withholdings, amounts that have been withheld from employee paychecks. Then we also have to journalize the payroll taxes that the employer owes, their portion of Social Security, as well as maybe FUTA taxes and SUTA taxes and stuff like that. We have to journalize those at the same time that we journalize these, the payroll, and as well as any workers' compensation insurance expense. And I'll talk, that's kind of a separate category that we discussed. We haven't really talked much about workers' compensation at this point. We've talked about unemployment insurance, but we haven't talked about workers' compensation insurance and how that all works. We're going to talk about that in this chapter, but that's going to be another journal entry that has to be made. Then when we actually make the deposit of those payroll taxes and amounts that we have withheld from employee paychecks and amounts that are owed by the employer, we have to make another journal entry at that point. And then here's this this third category, and these first two I kind of grouped together because they, with the exception of the workers' compensation insurance expense, I wish they wouldn't combine that with the payroll taxes, but these two kind of happen at the same time. So that's why I group those as the kind of the first category of journal entries, or the first grouping of journal entries that are made. Second grouping, deposit and payment of payroll taxes. And then the third, at the end of the period, we have to make some adjustments to make sure that all of our expenses are accrued in the correct period. Then at the end of the period, we're going to post all of those entries. So all these entries are constantly being made during the month. At the end of the period, we're going to post all of those entries then to the general ledger. The general ledger is a list of all of those accounts, and it's going to show ending balances, and it's going to show all of the transactions that have taken place in each of these accounts during the period. Okay, so this whole, and then of course after that, and if you've taken accounting cycle, or I know most of you I think are at least in principles of accounting right now, you'll know that the last step in all of this is all of the information from the general ledger, then it gets posted to a trial balance. The information from the trial balance then gets posted to the financial statements. Now, usually what happens is there's an initial trial balance, and then we make a bunch of adjusting entries for things like depreciation. These end of period adjustments may be part of that as well. All those adjusting entries that occur to make sure that the trial balance, the ending balances in the trial balance are correct. So then we have a final trial balance, an adjusted trial balance. That's what's used ultimately to create the financial statements. Okay, and like I said, if you've, I don't know how far you've gotten in principles, if you've gotten to this point yet. I think it probably goes through, I haven't taught Prin 1, so I don't know exactly what the schedule is for it, but it probably goes through this whole cycle, maybe early on in the semester, but that the payroll is, all these payroll entries fit into that cycle. And I know a lot of you as well, somebody had mentioned to me that I think in Prin 1 you just went through, or maybe it was Intro to Accounting, just went through payroll. So this may be a review for some of you to go through these. But those are all the transactions then that trigger, and the journal entries and the cycle for entering all of that information. All right, so payroll register, again, I'm not going to go through what's all in the payroll register. You know what's in the payroll register. This is a listing of all the transactions that happen or all, for each payroll, right? For each pay period, there would be a payroll register that would be generated. That payroll register, then the information, the total information from that payroll register is used to make those journal entries. And you're going to see that here in the slides in just a little bit, how that information then is extracted and how we create those journal entries from that. Now, they mention here that the payroll register should foot. That means that all of your columns, so you've got total columns on the far, we'll go on your side here, far right side of the payroll register, and then you've got totals at the bottom of the payroll register as well. All of those totals should match, so, or they should foot, they should be the same. Now, if you're using an Excel spreadsheet or a program like QuickBooks or some other type of payroll software to create that payroll register, that's going to happen. I mean, it's if you've got a formula that is being used, that should those should automatically foot. It is a good idea, though, to manually check that as well. Well, especially if you're doing it by hand, which I don't know anybody that would do it by hand these days. But if you're doing it by hand, then obviously you have to. It's just a it's a way to double check your math on for all of that stuff. So that's what they're talking about, foot. So foot or prove the payroll register. Ensure that the columns and the rows all total to the bottom right hand number. Okay, so that's that total amount there on the bottom right should, sorry, get cold. Everything across should total, everything down should total. All right, so employee earnings record, again, we've talked about this. The employee records earning is used in order to prepare the payroll register. First off, all that information's got to be transferred from that employee earnings record over to the payroll register. Employee earnings record, again, is the record for each individual employee, and it is cumulative. So everything that they've earned for the year, it is used to prepare all sorts of reports. So as you notice, when we were working on SUTA and FUTA calculations, well, especially the SUTA calculations, but also the FUTA calculations, because we've got those wage bases that we're working with, we have to know how much each employee has earned cumulatively at any point during the year. The way we know that is through the employee earnings record, is by taking a look at the employee earnings record to see how much has been paid to that employee. So, you know, for FUTA purposes, we know, okay, once we get to $7,000, we don't have to, any additional earnings for that employee aren't included. We're not gonna use that in our calculations of FUTA taxes anymore. And for SUTA purposes, again, whatever our state wage base is, we're going to stop once we get to that point. So the employee earnings record gets us that information, and we need to know on an employee by employee basis how much they have cumulatively earned over the course of the year in order to determine how much we owe, the employer owes, in FUTA taxes as well as in SUTA taxes. Also, state unemployment compensation. Oftentimes, employers will get requests from state agencies to give them a list of, you know, how much has been paid. Oftentimes, it's based on category of work. So, like, how many office employees did you have during a particular pay range, a date range? How many executives did you have? What was the payroll, total payroll for them? As well as, you know, how many production workers? What was the pay for your production workers during a certain time period? So you need you can extract that information as well from the employee earnings record, because you can categorize those employees by their job descriptions. Right? So all of over here, these are all of our office employees, and here's a total of everything we paid to our executives. Here's a total of everything we've paid to our production workers. A lot of times, both state and federal agencies will want that information in order to make certain policy decisions. So they gather that information from employers. So another reason why all of this information needs to be kept up to date at all times. And again, if when you're using software, it's going to be kept up to date as long as the software is decent, right? So analyses, and that kind of falls under analyses, I guess. Governmental agencies that are requesting that information, internal management as well, will use these records in order to assess where there are excesses of employees, and where maybe additional employees are needed in certain areas. So they'll use that for their own analytical purposes as well. Settle employee grievances, okay, well, or unions will also request this type of information, and the employee earnings record is used in order to provide that. Also, of course, the W-2s, since it's cumulative, it's going to provide us the information for each employee on how much they have earned during the year, what their withholdings have been, what garnishments there have been, what their net pay has been, and all that information is required in order to prepare those W-2 forms. And as it mentions here with payroll software, all of this stuff happens instantaneously. It can also happen directly from the timekeeping system. So if the employer has an electronic timekeeping system, maybe it's through a computer, maybe it's through like an electronic time clock, or through some other type of biometric system, all of that stuff can already be recorded and be automated, right? But as the payroll processor, you've got to make sure that all of the information is correct. I mean, there's still a lot of human input that is required in processing that payroll, right? It can't all be just 100% automatic. All right. Any questions about those two items? What we use the employee earnings record and the payroll register for? Okay. We're going to skip over these. All right. So, do we need any review on debits and credits or anything like that? Everybody's pretty clear on what all of that means. So, actually, I'm going to do something here real quick. I'm going to give you a little clue, or a little life hack, accounting hack. So as you recall from your accounting classes, our accounting equation is our assets. Well, you tell me, what's the accounting equation? Assets. So we got assets, liabilities. Yep. Liability. I think I spelled that wrong. Liabilities. Maybe not. And equity. Right. And our assets equal our liabilities plus our equity. So both of these sides of the equation have to, whoops, my head's in the way, have to be equal, right? So assets, we have certain classifications of or categories of assets, different types of accounts that fall under this asset category. We have different accounts that fall under liabilities, and we have different accounts that fall under equity. Assets, things like cash, property, plant, and equipment. We've got intangible assets, things like copyrights, goodwill, that sort of stuff. We've got, well, there's all sorts of them. Accounts receivable, amounts that people owe us, right? And then on and on and on. Then, sorry, I know this is kind of got a glare from my light. That didn't help at all. Sorry. No, well. Liabilities, we have things, these are amounts that we owe to others. So these are things that we own or others owe to us. Liabilities are items that we owe to others, right? So things like accounts payable, notes payable. Those are kind of the big two for liabilities, amounts that we owe to others. And then equity is whatever, this is what we own minus what we owe, right? So equity, our owner's equity, retained earnings, and that sort of thing. So this always has to balance. This side always has to balance with this side. And we do that. The journal entries that we make are ultimately a representation, essentially, of putting this whole equation together, right? So in order to make that work, we've got two sides of every journal entry. And I've told you guys I'm not a financial accountant. I'm a tax accountant. So you've probably been taught a lot better ways than how I'm explaining this. So we've got our debits, and debit just simply means left, right? It just simply means it's on the left-hand side, because our journal entries have two sides. There's always going to be two sides to every journal entry. And these journal entries have to balance. So just like our accounting equation has to balance, our journal entries have to balance. So debit just simply means left. And credit, I don't know why it's an R. There's no R in debit, but credit simply means right. So unlike on your bank statement where debit and credit mean cash in or cash out, that's not what this means here. It just simply means left and right. So certain types of, and like I said, it always has to balance. This debit side always has to be the same as the credit side. Our accounts always have what we call normal balances. These are the balances so for example, cash. If we have cash, which we should have positive cash, right? Our normal balance for cash is going to be a debit. It's going to be on the left-hand side, and we're talking about journal entries here. So, and this would be for any of our assets, any of our asset accounts. In order to increase them, so cash coming in is increasing, we are going to debit that account. Other types of accounts, like our liabilities, we would credit them in order to increase them. Remember, liabilities, amounts that we owe, assets, amounts that we own. Okay, so we would credit those liabilities. Now, there are certain types of accounts that we will automatically debit. Now, this is something that to kind of help you remember, okay, if it's a certain type of account, do I debit it to increase it, or do I credit it to increase it? And maybe some of you have heard of this mnemonic before. So expenses. We also debit to increase, and dividends. Dividends that we pay out. AED. Now, us Iowans tend to remember this by remembering Anderson, Erickson, O-N, dairy. Anderson, Erickson, dairy. So you can think to yourself, okay, so I've got, if I have an expense, I'm going to, I've incurred some sort of expense. I have to make a journal entry because I have incurred that expense. How do I make that journal entry? Well, okay, it's an expense, so it's one of the E's, it's the Erickson in AED. So I'm going to debit that expense. So for example, in our case, what we're talking about here are payroll types of expenses. Oh, and by the way, so everything else, I should put this down. So everything else, you're going to credit. So if it's not an asset, if it's not an expense, if it's not a dividend, then you're going to credit it in order to increase it. So you can also use that for, okay, it's not an expense, not a, you know, if it doesn't fit that one of these three categories, then you know you're going to credit it in order to increase it. So the accounts that we usually use in payroll, we use salaries expense, or wages expense. So it's got the word expense right there. So that we know then that we are going to debit, if we have a salary expense, we're going to debit that account. Now we haven't talked about the other side. They've got a balance, so we're going to have to have a credit as well, but we'll talk about that. Now within these expense accounts, you may want subcategories. So you could have, let's just say you use salaries expense. Maybe you want office salaries expense, and you want let's see, production salaries expense, and you want accounting. I know that might go under office, but maybe that's front office. Salaries expense, and you want purchasing salaries expense. So you may have subcategories under that greater category of salaries expense. These are good to have because then that provides more useful information for management instead of just a general salaries expense. Okay, well, how much, if all you have is salaries expense, how much did you pay the accounting department? How much did you pay the purchasing department? How much did you pay the officers? You don't know because it's all bunched up under one expense account. In order to solve that problem, you can have these sub accounts, and all of them then would be under salaries expense. So you would have the information for each department separately, and then you would have also a total for all of those departments. So the expenses, salaries expense, are one of the expense categories that we would use in payroll, salaries or wages. Okay, sometimes wages or salaries. Right. You could also subdivide it under salaried employees versus hourly employees. You could extract those two categories. You could extract any types of employee categories that you wanted. Okay. So wages and salaries expense is one of those types of expenses. We are also going to have payroll tax expense. Now, we've got two different types of payroll tax, right? We've got payroll taxes that have been withheld from employee paychecks, and we have payroll taxes that are owed by the employer. That's what I'm talking about here. Now, I think your book doesn't use this word expense for payroll. I think they just call it payroll tax or payroll taxes. What they mean, though, is it's an expense. This is the amount that's being paid by the employer for those payroll taxes. So we've got, because that is an expense to the employer, right? They're having to pay those payroll taxes as well. And under that would be things like employer's portion of Social Security, Medicare tax, also FUTA, SUTA. See, these are all amounts that the employer is paying. Employer's portion of those taxes. Okay, so here's two major categories of expense accounts that we're going to use. Now, these are expense accounts, so that means we're going to debit them. When we incur them, these expenses, we're going to debit them because we're increasing the expense. Therefore, it's going to be on the left-hand side of our journal entry. Okay, so AED, you can remember that, AED, then you can remember whether the entry should be a debit or if it should be a credit. Okay, as long as you can remember that AED, assets, expenses, and dividends. So again, and we're going to talk about some of the credits as well, but I wanted to kind of focus on the expenses that we're going to look at, because there are other accounts that we're also going to, other types of accounts that we're also going to be either debiting or crediting in our journal entries. Because think about one of the big assets that we have is something called cash, right? That's our biggest, that's our most liquid asset. Cash, when we pay employees, we got cash going out, right? When we pay our payroll taxes, we've got cash going out at that point. So for these expenses, a lot of times you're going to have cash as well. Now, this is kind of weird. Cash is actually going to be on the right side, even though it's an asset. We're not increasing it, we're decreasing it. So if we are decreasing it, I'm gonna do this. And I'm gonna do this too. Oh, the red doesn't want to erase. So cash, assets, whoops, assets. When our assets go down, it's gonna be on the right side of our journal entry. When our expenses go down, you don't usually see that very often, but you can. An expense, decreasing expense, maybe you got a refund for something. Dividends, you don't see this very often either. We're going to credit it if it's going down, if we're decreasing amounts in those accounts. But again, it's the same, AED. So everything else, though, we are going to credit in order to increase it and debit it in order to decrease it. If it's not an asset, not an expense, not a dividend. Okay, so that said, let me see here. All right, so I'm going to put the liabilities back up here. So liabilities would be an account that we credit to increase. Now, some of the liability accounts, remember when a liability is something that we owe to somebody else, right? So when we incur an expense, but we haven't paid it yet, that means we've incurred a liability, okay? So usually these accounts have the word payable in them. Whoops, means we have to pay it. We haven't paid it yet, but if it's got the word payable in it, then it's a liability. So payroll taxes, or well, actually your book subdivides it, so I'm going to subdivide it as well. So FICA taxes payable. There's that word payable. FUTA taxes payable. SUTA taxes payable. Other types of amounts that the employer has to, they've incurred the expense, but they at some point have to pay out. Okay, so the word payable is going to show up when it's a liability, and we're going to go through again all the different accounts that we use when we're talking about making these journal entries. Okay, so just kind of a preview, I guess. Not really a preview. I don't know what you'd call it. A sidebar. But that AED is what I mainly wanted to point out to you. The Anderson Erickson Dairy assets, expenses, dividends, we debit to increase. Let's go back over here. All right. So how do we record this? And this is a little, I think this is a little bit out of order, because what we're going to do is go through some different types of withholdings, amounts, voluntary withholdings as well, but they have us look at this first. So that's fine. We'll go with this. So the total gross payroll is, and this is when we actually pay the employees. So we're paying the employees. We've got a payroll, we're paying the employees. The gross payroll is our debit portion of the payroll because it's an expense. We are increasing that expense, so we are debiting it. But the total gross amount, not the net, but the gross amount of pay before anything that we've withheld is going to be our debit portion of that. And it's going to be our wages expense or salaries expense. Maybe we're going to subdivide it based on different departments. That's fine. But it's still an expense, so we are going to debit it. The withholding, the amount that we're withholding from the paycheck, is going to be that's a liability. We're taking it from the employee, and we're going to have to pay it to the IRS or to the state. We got to send that off somewhere. So now it becomes a liability to the employer because it's money that has to go out. It hasn't been paid yet. So all of the withholding is going to be credited on the other side of the journal entry. That is a liability. Remember, we're increasing our liability, so therefore we have to credit it. There's one other item that we will credit in our initial journal entry, and that is cash, because cash is what's actually going out to the employees. This is the amount of cash. So yes, it's an asset, and we debit assets to increase them, but we're not increasing it, we're decreasing it. So that means we have to credit it. Okay, I don't know if my hands are going in opposite directions here, but so we are going to also credit cash that goes out. So let's actually take a little look here. Let's say we've got an employee. We'll just have one employee at this point. Whoops. Forgot to click that. Okay, so we just have one employee at this point, and we've got their gross paycheck gross pay, can you see that? Okay. Gross pay was $1,000. Whoops. And then we had Social Security tax of, let's see, so it's 62. That was withheld. We have Medicare tax that was withheld of $1,450. Got federal income taxes of $200. Okay, and state income taxes of $100. So our net pay, we're just going to do the math on that. What do we have? So 700 minus 7650. So 600 and what is it? 630. Somebody help me out here. 600 and why can't I do this in my head? All right, so 700 minus 623.50. So there's our net pay. This is the amount of cash that's going to go to the employee, right? So if we think back to what we just talked about, that the debit portion of our entry is going to be this gross pay, which is our salaries expense. Here's our debits and our credits. So salaries expense is going to be debited. All of the rest of these, including the net amount, are going to be credits. Okay, these amounts here are payables, so they're liabilities, and this is cash. So we're going to have, and we can lump all of these, well, we'll say FICA tax payable. Sorry, crunch that together a little bit. So FICA tax, these two, $76.50. All I did was I added those two together. Federal income tax payable. We're just going to transfer that down here, so $200. State income tax payable, $100. And then let's not forget our cash that's going out. Hopefully you guys can see all that. Cash of $623.50. All right, so that's what our journal entry would look like. All of these are credited. That's our only debit here. Now, remember I said they have to balance. That means all of these need to equal $1,000. All right, well, we've got 300, 923.50, 924, 76, 1,000. Magic. They do balance. Okay, so this is the very first journal entry that we would make, and we make it at the time that we pay the employee. Okay, so like I said, so debit, the very first one, our gross amount is going to be our debit. All of these, including that net amount, are going to be credited to the different accounts. And then they have to balance at the end. Are there any questions about that? This is just the first journal entry. All right. Let's go back right. Did we just do this? Okay, so those are just the basic accounts. That's what I showed you, was just including taxes, right? We didn't include anything else, any of those other pre-tax or post-tax types of deductions. We didn't include any of that stuff, right? So there are various other types of deductions that could occur that the employee could, well, they could choose. It could be voluntary amounts. So things like insurance, if they're choosing to participate in their group insurance plan, but they have an amount, the employee has an amount that is withheld from their paycheck for that, that would be another type of withholding that would occur. So it would, if you can see this again, it would be included then in one of our credits. That amount would be credited. All of these amounts here, if they are withheld from employee paychecks, are going to be credits. So health insurance, life insurance, purchase of government savings bonds, union dues, any garnishments of wages. So these are amounts that are required to be withheld, pension and retirement contributions that are made by the employee. These are all amounts that the employee makes. So we're going to talk a little bit about each of these groupings here, or each of these categories of withholding, different types of benefits, just to kind of get an overview of them. So group insurance, I think what they're mostly talking about here, like life insurance, because they specifically talk about health insurance separately. Yeah, so employees can obtain life insurance at a lower rate if it's purchased by an employee as an individual. So rather than purchasing it out on the open market as an employee, you would have the ability to purchase it at a lower rate. There's some cases where the employer might pay a portion of that, and the employee might pay another portion of that. The total amount withheld is credited to a liability account with the title Group Insurance Premiums Collected or Group Insurance Payments Withheld. Okay, now it's a liability, but they're not calling it that because it was something that was withheld from the employee's paycheck. So, but again, this is a liability. The employer is going to have to pay that amount out at some point in the future. So it becomes a liability. If it's a liability, we're increasing that liability, therefore we're going to credit a liability account in order to increase it. So it becomes the same. It would be, let's see. So it would be treated the same as one of these types of accounts. So it would be a credit over here. Okay, and we'll do some examples of these as well. So. Health insurance, same type, just another type of insurance, right? So health insurance is one of those benefits that a lot of employers will provide, but oftentimes employees have to pay some portion of it from their paycheck. Remember, that's pre-tax if it's part of a cafeteria plan. Yay, that helps the employee tax-wise, but we've already done those calculations. Now we're to the point where we're recording it in the system, or in the accounting system. This is so any amounts that are withheld from employee paychecks are going to be considered a liability, and they are going to be credited just like the taxes that were withheld, and just like the life insurance that may have been withheld. So this is just the employee portion though. Okay, the employer portion would be a separate journal entry. It would be a completely separate journal entry. And oftentimes what happens is that employers will pay at the beginning of the month for the health insurance. They'll just pay all of it, the entire premium, and then as employees are paid, amounts will be withheld from their paycheck in order to pay the employee's share for the amounts that have already been paid by the employer. So oftentimes they're paid in advance. They're debited to an account called prepaid health insurance. That's an asset account, so that's why it would be debited. But it works for our purposes, it works the same as any other type of withholding. We're going to credit it in our journal entry. Purchase of savings bonds. So you can purchase savings bonds through automatic withholding from employee paycheck. Certain employers will allow this, usually larger employers. It's the same concept. Amounts are withheld from the employee's paycheck, so therefore any amounts withheld are going to be credited in the journal entry, because the company now has to set that money aside and then pay it at some point in the future. Okay, so this is one of those benefits. Some employers offer them, some employers don't. It doesn't provide any tax benefit. It's a post-tax deduction for employees' purposes, but it may help them to, if they're not real good at saving, it may be a way for them to save money. If you never have it, if you never receive it, then chances are much greater that you're actually going to save. Union dues. Also, these are not pre-tax. These are post-tax. So there is no tax benefit from contributing to union dues, but they are oftentimes withheld from employee paychecks to ensure that the amounts are actually paid. It would be recorded by debiting the withholding would be credited from the employee's pay account. I mean, in the journal entry that is made when the employee is paid. So it's going to be another credit because it's an amount that's withheld. Ultimately, when they're paid, we reverse that and we then debit the liability account. We're going to decrease that liability and then credit the cash account. We'll talk a little bit more about that in a few minutes as well. All right, garnishment of wages. Now, garnishments are different from these other withholding, these other deductions that we've just talked about, because garnishments you don't have a choice. Some credit agency or maybe the IRS or student loans are being collected through the employee's paycheck because they haven't paid those amounts. So creditors, it has to be through a court order. So if you're working in payroll and you just get a notice from a creditor, if it's not a court order, then you can't enforce that, right? It has to be through a court order, the garnishment. What happens is the employer has to withhold funds from the employee's paycheck and then submit those funds to the appropriate agency. Child support would be another type of garnishment. You don't have a choice in it. You have to comply, right? If the employer does not comply, as you can see, then the employer now is on the hook for that debt. So not a good thing. Now, sometimes people will have multiple garnishments in place, and there is a hierarchy of garnishments. What comes first? First would be either federal taxes owed or child support, whichever of those two was delivered first. So federal taxes on par with child support. Next would be bankruptcy. So any bankruptcy orders would come in front of any other private claims. Last would be any other creditors. So like, I don't know, credit cards, any other loans, auto loans, those types of things, student loans, federal administrative wage garnishments. I'm not quite sure what federal administrative wage garnishments are. There can also be, by the way, like the state can also garnish as well. So not just federal, not just creditors, but the state could also impose a garnish. Now, there are limitations on how much can be garnished. You cannot garnish so much from an employee's paycheck that they have nothing left. Okay, you can't send them into total and absolute poverty from the garnishments. These are and all of those amounts are dictated by this Consumer Credit Protection Act. So what are some of those limits? So the maximum amount of disposable earnings that can be garnished for debt repayment is whichever is less of these two. This is the maximum amount, 25% of disposable earnings for the week, or the amount by which disposable earnings for the week exceeds 30 times the federal minimum wage rate amount. So whichever is less of those two, 25% of disposable earnings, or the amount by which disposable earnings exceeds 30 times the federal minimum wage amount, or the federal minimum wage rate. Okay, so those are some of the limitations. Child support has some different limitations, though. These are pertaining mostly to, this is for debt repayment. Child support is governed by this Family Support Act. And we talked about early on when we talked about those new hire reporting forms, that as part of that, the state will report, or the employer will report to the state that an employee has been hired, and that notifies the state to implement any child support orders that may be outstanding. This is going to take precedence over most other types of deductions. So the maximum that can be withheld varies between 50 and 65% of disposable income, depending on other obligations and the number of weeks that the employee is in arrears. So how much they actually owe, how long it's been since they've actually made a payment for child support purposes. Federal taxes, so they take priority after wages are withheld for child support, as long as that child support levy was received before the federal tax levy. So it had to be in place first. Tax levy will take place within 3 days from the receipt of the notice, and with the very first wage payment. So it's got to take effect immediately, essentially. Once the payroll department receives notification of a federal tax levy, they've got 3 days to implement that federal tax levy. Okay, so those we're talking about involuntary types of deductions. Pension and retirement contributions may or may not be voluntary or involuntary, depends on who you work for. If you are a state employee, you are required to contribute to a retirement plan. You don't have any choice in the matter. But for a lot of private companies, you've got a choice whether or not to participate. There are certain types of plans. Well, certain plans, it's up to the employer whether they want a plan that allows employers to contribute as well as employees, or if it's only the employees, or maybe even only the employers that are going to contribute. Obviously, if the employee contributes, then that is going to be another credit in this initial journal entry. So that's going to be part of the credit because it's an amount that's going to be withheld. Now, normally, remember, retirement contributions are going to be excluded from federal taxable wages and state taxable wages, but not from Social Security and Medicare taxable wages. So the deduction from the employee paycheck is recorded as a liability. And then once the actual payment is made, that deduction, that liability is reversed and is then subsequently credited when the actual payment is made. Okay, so some different types of amounts that are withheld, that could be withheld from employee paychecks. And by no means is that list exclusive. There can be all sorts. Remember, we've also got flex accounts. So if employees choose to contribute money to a medical savings account or to an HSA or for dependent care expense account, that sort of thing, that could also be another type of deduction. So there are tons of different types of deductions that could take place. If an employee decides that they're going to contribute, like a charitable contribution, that could be another type of deduction. So all this, like I said, by no means is that an exclusive list. It's just a short list of some of the most common examples of deductions that could take place there. Any questions about those deductions or garnishments before we move on? No? All right. So I'm just going to go through this. Let's see. We'll start looking at the journal entries specifically on Thursday. I think we'll go ahead and just finish up with these few slides here. So employers have lots of different ways that they can pay employees. Most of them will pay, probably direct deposit is the most common way of paying. EFTS checks could be issued. Employees can be paid in cash. It is possible to pay in cash. Doesn't happen that often. Usually it would only be like a day laborer type of situation. But it can happen. It doesn't mean that you still have to make the journal entries and you still have to withhold the taxes and all of that. So just because they're paid in cash doesn't mean they're exempt from all of those other rules. A couple of, or actually one kind of, this is becoming a more popular way of paying, at least it was for a little while, is paying through pay cards, especially I think fast food restaurants, especially, is where I've heard of it being utilized the most. So employees, and this is mainly for those employees who don't have bank accounts, and there are a lot of people who don't have bank accounts. People have, I mean, they've got a multitude of reasons for not having a bank account, but there are a lot of people that don't have bank accounts, and so the employers have started paying employees essentially on debit cards. So they'll get like a Visa or MasterCard or something that works like a debit card, and their pay is then deposited onto that card. Cash can be withdrawn at an ATM, but of course there are limitations on these cards. My understanding is a lot of the cards, they have, they've got like monthly fees, monthly maintenance fees on them. Of course, a lot of bank accounts do too, so that's not necessarily something that's exclusive to the cards. But you can't, it's difficult to make certain payments with a card, like rent payments or mortgage payments, things of that nature. They're cheaper for the employer to deposit the money on the card than it is to create an actual paper check. And for those employees who don't have a bank account, this is a way for them to receive their funds. Now, my understanding though is that employees it has to be a choice. The employees have to opt into it. So they can opt out of it. So they can choose not to be paid in that manner as well. Pay stubs. So employees like to receive pay stubs to determine, they can look at how much they got paid, what the withholding was for that pay period. Maybe there's a cumulative amount as well that is included. There are lots of different ways to do that. It can be on paper, printed on paper. It could be emailed. It could be something that's downloaded from a website. Lots of different ways that information can be distributed to employees. So final pay, and I think we've talked about this a little bit, varies state by state when the employer has to make that final payment. In Iowa, doesn't matter whether the employee quit or was terminated involuntarily. they won't get paid until the next regularly scheduled pay period. But there are certain states where employees have to be paid sooner than that, maybe by the end of the business day or the end of the, maybe employers have a week, or maybe immediately they have to be paid. So, but there is no requirement under federal law that employees be paid within a certain period of time once their employment has terminated. Okay, last thing here that I want to talk about is unclaimed wages. So what happens when you have an employee, and this is usually only going to happen with checks, right? If it's direct deposit, this really isn't an issue. But if you have an employee, and believe it or not, this does happen, who doesn't cash their paycheck. You issue a paycheck and they don't cash it, and they don't cash it, and they don't cash it, and the check is outstanding for a long period of time. Well, what happens to that money? It does not go back into the hands of the company. The company does not own that money. The employee owns that money. So what has to happen is there has to be enough attempts to reach that employee. Maybe they moved, all sorts of things could happen. But there has to be attempts to reach that employee. After 1 year, though, if the employee still has not cashed that check and has not claimed it, then the money has to be surrendered to the state. What does the state do with it? The state then attempts to locate the employee. And the state of Iowa has, maybe some of you have heard of this. Let's see if I can find it here. See if I can remember what it's called. Here it is. It's called the Great Iowa Treasure Hunt. And it is a list, all of the unclaimed property. If the employer has unclaimed property, which a paycheck that has not been cashed would be considered unclaimed property, then they would report it using this website, and they would have to send then the funds off to the state. Again, it doesn't belong to the employer. I'm sure there are a lot of employers out there that just decide they're going to keep it. It's not their money. So they would report it here. You can also search for unclaimed property. So let's just see if let's just see if I have any money out there that I haven't claimed. You put your name in. Nope, none of these are me. So I don't have, there are some Kelly Murphys out there and Kelly Westfalls that are due an amount, but you could, so in looking at this, let's just choose a really common last name. You could go and look, go search and see if there's any money out there. Let's find a good one. There's got to be somebody that's due over $100. Oh, here's over $100. So Bernard Murphy in Dunlap, Iowa, is due over $100 from Discover Bank. They've got some money for him. He could go and claim it. So you should go. It's called the Great Iowa Treasure Hunt, but this is where it's reported by employers if they have paychecks that have not been cashed. So you could go on there and search and see if anybody owes you any money, right? All right. So, and there are, if employers don't report it, there can be some pretty stiff penalties for that as well. Okay. Any questions? No? All right. So on Thursday, we will go through some journal entries, how to report all of these entries into the accounting system. We already kind of got a little preview of that today, but we'll go through it in more in depth on Thursday. Okay. All right. Well, thank you all for showing up. I appreciate it. And I hope you have a good day. Be careful driving. I don't know what the weather's supposed to be like. I think it's supposed to get slick. We'll see you on Thursday.